What is going on, ladies and gentlemen? I am not a financial advisor. This is not financial advice. You get the deal. There's one more day for the Apex 90% off sale, so I highly recommend getting a few accounts just to trade and work on your strategy. They're so cheap. And yeah, so make sure to click the link in the description if you're interested in getting one of those. You don't have to type in, you just have to click the link and then type in code SAVE90, okay? I don't have a special code. And lastly, if you want to be joining my ICT live streams, I live stream every single day, and I predict this all in live time. I don't mostly do morning sessions, sometimes afternoon. But if you're interested, click the link in the description, wap.com. And yeah, so let's get started. So this is probably going to be a little longer of a video. So keep that in mind, okay? I'm going to be going over everything you need to know about liquidity in this video, okay? So there's kind of multiple aspects to liquidity and how I trade liquidity, and it all has to do based off of ICT concepts. And I'm going to be showing you kind of the basics and the number one way to use liquidity and just what you should know about it, okay? So when I say the word liquidity, okay, what people mean is highs and lows, okay? For example, this is liquidity, okay, and this is going to be very basic, but I'm going to get into some more advanced stuff for you more advanced people here. This is the low, and this is the high, and it's liquidity because there are sell stops resting above here and buy stops resting below here. So what the market does is it basically targets these stop losses, and it tries to wreck all the people longing based off of quote-unquote support, okay? So if you think about it and how many people in the market fail, what's the market want to do? The market's going to want to target these highs and lows where it knows there are stop losses, in other words, liquidity, and stop these guys out, okay? And there's two terms. There's sell side liquidity, which is the low, okay? And there's buy side liquidity, which is up here, which is the high, okay? So buy side's always the high, sell side's always the low, never changes. Okay, and there's two types of buy side or sell side liquidity. Okay, let's just talk about buy side liquidity. There is internal buy side liquidity and external buy side liquidity. Okay, there's two types. So internal and external. And it's important you understand the difference, especially if you're kind of talking to an ICT trader, because sometimes they might use this language or this jargon of speech. But there's two, internal, external. If you think about the word internal means like inside a room, but external may mean outside a room. So if you think about this and have to make a guess, okay, we look at the next swing high before this major buy side liquidity, which would be right here. Okay, you can see it's a swing high because there's a high, another high, then a lower high. This would be internal liquidity, because it's inside the range, right? It's inside sell side and buy side. And this would be external buy side liquidity. So this would be internal buy side liquidity, okay, like this. And this would be external buy side liquidity up there. Okay, and how do I trade using this liquidity? Okay, this is where it starts to get a little more advanced. Okay, it's very important when I'm looking for a long setup, okay, I always make sure we haven't hit internal sell side liquidity or internal buy side liquidity. So let's say I thought the market was going to go to this low, right? Let's say I thought the market was going to go here. And I'm looking for, let's say, an inverse, okay? I teach inverses a lot. We see a bullish fair value gap right here, and we see a nice giant candle close through it. Okay, so now it's turned into an inverse, and the important thing here is you can already see we kind of swept this liquidity up here. See how he swept it, but we did not displace above it? That is a sign that we are bearish, okay? So right here, when we sweep this buy side liquidity, which would this be internal or external? I'll give you a second to pause the video and you can answer. Okay, if you pause it, this would be internal because it's kind of inside the major high. If you look at like the 1 hour, see how this is the major high. So this would be an internal range liquidity because it's inside the hourly high. And this would be the external. So we swept the internal high and we inversed this fair value gap right here. Okay. And now what you can want to look for is a fair value gap setup, which would be like right here. Okay, I'll make this yellow. And why would this be a good setup based on liquidity? This is a good setup to me because see how we knifed and created the fair value gap, but see how we did not take internal liquidity? If we look to the left, we'd look for internal liquidity, which would be right here because there's a swing low, a low, a lower low, and then a higher low. So this is a swing low. So see how the wick comes almost to it, but we don't hit it? This is a good sign to take this fair value gap because if I am targeting sell side liquidity and I'm wrong, okay, if I'm wrong about this draw and I'm targeting sell side liquidity, think about it. If I'm wrong and we go in the replay mode real quick, and let's say we got a candle like this, okay, if I'm wrong, at least we're going to hit this and then we're going to go up here because if the bias is truly bullish, the market will take out these stop losses and it will reverse. Okay, so basically if I'm wrong and we come back up to this fair value gap and I try taking a short thinking we're going to go lower, I'm going to get wrecked and we're going to go way back up here back to the high. Okay, but let's say the candle only came down here and then retraced to it and I'm wrong still and I still short it. Well, at least here I have a better chance now that at least we're going to hit internal liquidity because the market is always going to want to target stop losses before it goes up or down. So if we have not hit internal liquidity and I'm wrong about heading down here, the market's still going to want to go at least to this internal low. So how I trade liquidity is if we reverse before hitting like a short-term low right here without hitting this, I know for a fact that 99% of the time, this setup's at least going to get me down here, okay, which is, this is a 6-point setup still. So what I do is, if I'm wrong, just in case, I'll scale some or cover some, okay, so I'll basically cover some partials here, and then I'll move my stop and break even because if I'm right, we should not trade back into this. We should go right down the sell side. Okay, so kind of using the highs and lows, if we did this, I'll not short it because that gives me more of a chance. That means if I'm wrong, we're going to go up here, okay? But if we have not hit the internal low, then I'm definitely going to short it because I at least know we're probably going to hit this internal low because if the bias was truly bullish, we would probably run these stops anyways and bounce out of like a higher time frame fair value gap, which in this situation, it would be this one. Right, because the markets wants to deliver from inefficiency to inefficiency. So if the bias is truly bullish, at least we would hit this internal low and then bounce. Okay, so I'm going to go over a few more examples about how I do this. Okay, using I'm going to use gold right here. So this is a good example. Okay, you can see gold. Let's pretend these are perfect equal highs, right? And let's say I thought this was the draw on liquidity. Okay. So in this example, I look for a market structure shift, okay, and a fair value gap, and I look to buy in the fair value gap. So in this situation, okay, if I'm buying in this fair value gap right here, okay, I'm at least expecting, give this a second to load, I'm at least expecting us to go at least to this internal high, where I will take some partials off and hold the rest till here and move my stop to break even. So you can see right here, this is sell side liquidity, right, because it's at the low. And see how we barely displaced under it? And see how we kind of wicked under and then got a big fair value gap back to the upside? This tells me that this is a good long setup, especially the market structure shift. And if I'm wrong, we will at least probably run these stop losses before going down again. Because whenever you see a fair value gap deliver, we at least deliver to the next high. So let's say I thought we were going here, and I have a take profit up there, okay? And I'm longing this. I'm at least going to take some partials here just in case I'm wrong and put myself break even. Because if I'm wrong, we're going to go back down here and I'm going to get stopped out, okay? And if you look at replay mode, we hit the take profit, and then what happens? We just dump. So see how this almost like guarantees, and me trading liquidity, see how it almost guarantees at least some profits if you just target the next high, okay? And would this be the internal or external high right here? I'll give you a second, you can pause the video. So this would be the internal high because it's in between kind of the bigger buy side liquidity, which I'll be targeting. Okay, so that's another example. That's why I only target the internal high. Same thing with the Euro USD. This morning in my Discord, I tweeted down here, or I sent down here, this is bullish. Okay, you can see we have a lot of low resistance liquidity, which I'll go over in a second, almost like an algorithmic trend line. So I figured we'd pump over it. And what you do is if you long this fair value gap right here, you're at least putting your partials to this high, because if you're wrong and buy side really isn't up here, we're at least still probably going to hit internal liquidity, okay, this high, and then go back down. Okay, so it's smart to take some partials here and then put some stop losses and put stop losses at break even, okay, because you at least know we're going to hit this. And just for back testing, most times we hit like an internal high, which would be this high, and come back down to a stop at break even. Most times you continue to hit the normal stop loss anyway, which means if I have a stop loss at this low initially, okay, let's say my play was like this, most times you end up getting stopped break even after hitting your internal high. We'll end up going back down here anyways. Okay, so this will probably end up happening anyways. It sometimes will still work, but the majority of the times will come back down to that low. So that's why I do it. Okay. The other thing about liquidity you should know is low resistance liquidity. Okay, all that basically is when we have like a really algorithmic trend line. Okay, so if I go back to Euro USD, the other day, okay. See how, like on the 1 hour chart here, what was it? It was right, I think it was like actually going to 5 minute. So on the 5 minute chart, see how like right here, see how from like here to here, see how like algorithmic this is? We have 1 touch, 2 touch, 3 touch. Usually that creates a trend line, and usually those trend lines are meant to be broken. Even the mini trend lines. Right, look how perfect this is. Okay, like you can see how perfect this is. It's a mini trend line, but it's so perfect that it ends up breaking. Okay, and like even, let's see, I think there was a good one on ES the other day. Even like these mini low resistance liquidity lines, they'll get broken as well. So for example, something like this. Right, it's a perfect uptrend almost. We touch, 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 touch. These, what do these do? These are just engineering stop losses, because what people do is they'll put their stop losses under the trend line, and then we trigger them all at once to go down. Okay, so that's the other thing about liquidity you should know. It's when you see like a bunch of highs and lows in a row. For example, here, 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 here. It just makes them really easy to run through. And the market will just kind of dump through them, take this stop loss, take this stop loss, take this stop losses, take this stop, take this stop. And eventually leading down to take this stop loss, which is at the bottom. Okay, so that's the most important thing you should know about that. So how do I trade inverses using liquidity? Okay, what I do is I keep it very simple. I look for some sort of low to be taken out. So in this example, I see this low is taken out, and you can see like we kind of wick under it. We don't even close under it. Okay, we close almost to the tick. Okay, and then what I see is this. I see a bearish fair value gap right here that was closed back above. So for my strategy, I use sell side liquidity or buy side liquidity if it's going the other way, and I look to see, are we taking a low, and does a fair value gap that takes out a low, is this being closed back above? And if both answers to that question are yes, I generally long. So in this example, you can see we have a bearish fair value gap here, and you can see this candle right here at 1205 closes back above it after purging sell side liquidity. So this means this is a good long. Okay, what if sell side liquidity was down here? Would this be a good long? Probably not, okay, because the stops weren't ran yet. So why, if the stops weren't ran, why would the market want to reverse, right? Unless there was some sort of SMT, but that's a whole nother video. So in this example here, okay, you just have to be careful, make sure kind of yesterday's low day, London low, any of those are good targets, or purged before looking for the inverse model using liquidity. Okay, so it's just very important you understand that. And like same thing with buy side, okay? Max this out. We got a really nice inverse today. Okay, if you look in the 15-minute, like I said, this is another inverse fair value gap where we took out this high, which you might not catch this in live time, but what are you going to catch in live time? You're going to see we barely displaced above this high, and maybe when you see this close, you're like, we took out this high, and we get a close below this. Now this is an inverse. After taking a high, I'm going to try a short. And all you do is you just target the next fair value gap if we have one, which in this case we did. So you target this, and then the next target would be back to the low again. So I'm sure many people are still in this position if you trade with model, and you can see the risk reward for a play like this. What I don't mean that would be something like this, and a close would be back above the inverse, wherever that would be. And the ultimate target would probably be down here, and then your partials would be right here, and then maybe some like right here at this swing low, and then you just hold runner so down here. So in this situation, the market, you always target the next lower high. But again, you got to make sure you're taking partials and internal liquidity, because if we hit this internal liquidity and your bias is wrong, we could easily reverse and go stop you out. So that's why I always move my stop to break even when we kind of hit that internal liquidity. And then I target the next low, okay? And I'm never going to leave a full position until this low, because if my bias is wrong, that's too risky. As long as you can secure some profit and then leave a position, you're still going to be pretty profitable, okay? And you're just going to have a higher win rate. So it's a win-win, okay? So this video, it's gone all over liquidity. Let me know if you have any questions. I think that's the basics and kind of how I trade it. But if I'm missing anything, let me know. Appreciate you guys watching, and other than that, peace out.